Moving averages, one of the easiest things to look at and apply, one of the most scrutinized pieces of technical analysis. In this video, I'm going to show you ways to use this tool to not only set you up for the near-term trades, but to also show you how to capitalize on long-term secular trends that can last for years. I will show you just how simple they can be to read. Now, I am going to show you how you, as an investor/trader, can use these simple tools to help navigate these troubled waters we call the marketplace. So sit back, give me your full time, your full attention, and I will show you how to use this indicator for the near term or for secular trend growth.
Now, shall we begin?
I got my indicators page pulled up here. I am using this indicator right here by Spectrolight, and it is an EMA-MA combo. What this does is it gives you 4 exponential moving averages, and those are the moving averages we are going to be talking about in this video, all right? But it also gives you 3 simple moving averages. So this way, it's all in one little tight package, and it ends up being one indicator. Here, the first 4 are your EMAs, the bottom 3 are MAs, and the inputs that I currently run, I believe these are the default numbers. But if they're not, you can adjust them simply by this. 21 exponential is going to be your fastest one, the 55, 100, 200, and that's all we're using, and that's what you see on the screen here. Now, I'm going to go to the SPX. All right, the reason for this is simple. The SPX has the greatest amount of data, and we can literally look at these moving averages on a monthly time frame, but I typically stick to daily and weekly only. I don't go higher and I don't go lower. So if I'm looking at moving averages on an intraday basis, then just ignore them because I just forgot to turn them off. Daily, weekly time frames. These are the best 2 time frames that I have figured that these time frames will show you secular trend growth and when you should potentially get out or apply a short. In a perfect secular bull run, the moving averages should be the 21 on top, the 50 beneath, then the 100, then the 200. When that is not the case, the market is either choppy or changing trend. All right, so let me go to an example that I did just last Thursday. All right, because that's when we had a live stream. I basically showed everybody that on the S&P 500, as far as everybody is concerned, this is structured bullish. It is very structured bullish. In fact, to be even considered to call this a bear market, all you need is a 20% downfall before the news will start calling it a bear market. But for me to really see that, the asset is weak on a daily time frame, I want to see this thing lose all the moving averages. I want the moving averages to flip. So here it is on the daily. This is when we started the bear market. You can see how first price drops, and it drops hard. So you're all the way down here before you finally get that move lower where the 21 crosses below the 50, and also you trade sideways for like 3 or 4 days here, and then the 21 breaks down through the 100. So you've already lost the 50 and you've lost the 100. That's the circumstance. You can interpret that this is going to happen because remember, if it's a lagging indicator, this only plots, these indicators only plot on their time frame. So if you're on a daily time frame and I'm looking at the 21, that means that this indicator is plotting the 21-day average. So if you're on the week, it would be the 21-week average. So whatever moving average you have pulled up, if you're using these, the 200 means it's going back all the way to 200 periods. One period is 1 day. 1 week is 1 period. So if you're looking at a 200 weekly, it's going to look vastly different than a 200 daily, right? They're going to be complete and total different places. And I'll show you this simply by clicking on a 200 week. Now, this is your 200 week. And as you can see, it is way down here. All right, so here's the 200 day, there's the 200 week. Now, this is also just a simple moving average. It's not an exponential, but even if it were an exponential, it'd still be way down here, right? It would not be up further. It would still be in this area, just shaped differently, I guess. But anyways, not to get off topic, you can interpret that this is about to happen. All right, because if you lose your 50, right here was a pullback day. So in this is all chop, right? This is when the market was making a top. So it got choppy and then boom. Typically when we lose the 50 on the RSI, which is right in here, right? And the 21, which is here, we start to look for shorts. As long as you have a price level, you take the short. You would have made good money on that trade. So anyways, you can see how it went down close to the 100 and bounced, close to the 100 and bounced, close to the 100 and bounced, right? But then we have 3 nice days of downside. This one was an up day, but it gapped down, moved lower, and then closed up. And then the next day was a gap down, move down. Next day, it closed right on the 100. You get another move down. And if you look at this, let's pull up the bar replay. Use the bar replay tool, people. It really, really, really helps you as you start to learn about price and how price moves. I'm just going to show you how many days it took to move down before the 21 started to tweak. All right, as you can see right here, the 21 on this day went boop down. Now there's possibility that we could get a bounce here because we're at the 21, but we don't. One more day. Now you can see that the 50 has lost its upward slope and is pointing down. So at this point, we have lost the 100 and the 50 and the 21, but we can anticipate that this is going to cross unless price starts to break out of here and move to the upside. Another big move to the upside. Now, with this opening up slightly from the previous day's close, this move up would have been a selling opportunity. But you can see that now the candles are getting bigger. So we pretty much know now that we need to wait for a push up because we're getting near oversold on the daily here. So you can anticipate that the moving averages are going to cross, and then you get oversold on the daily, you test the 200, you are now in the process of crossing the 50. We're watching this big boy right here. Once a downtrend gets underway, you will get spikes above the 21 and you'll be like, oh, it looks like we're going to be back to bull heaven. But that's not always the case. Let's move it back. Here was a big drop. We're definitely got the cross. That is called a silver cross. When the 21 crosses the 50, it's called a silver cross. And you can see that you have already missed a huge move before you ever even got the silver cross. But once again, I told you, once you get a close under the 21, you can start to look for those bearish moves. You're just looking to try to get into these day trade entries via using the 21. Now here, you bounce back up out of the bearish territory because the 50 separates the bulls from the bears on the RSI. But when you get under, then that means the bears are in control of the asset. So you always want to look to sell on an up candle, any up thrust in price. That's where your selling entry happens. But you have to have a stop loss, a defined stop loss. So even if you would have got in at 46.5902 using this candle, you would have caught that entire move to the downside. Now you want to take profits, move stops, and then look for a re-entry. Here we go where price is just kind of trading under the 200. It's really making bears jump in because they're like, oh, 4 days we've traded now, and we have not been able to break back above the 200. And also, if you notice, not only have you crossed this, but you have also crossed your 100. The next moving average is that 200. So if the 21 crosses the 200, price is pretty much heading down. So let's move forward a little bit further. So we can expect a bounce from this based on the fact that the bears were shorting into this at the 200 exponential because they figure that we're going to see a much larger move to the downside. And then boom, we break back above and close back above. This is a bullish engulfing at a form of support. The 200 exponential moving average is also a form of support. All right, move ahead. Here we come. Now the 21 has turned and flattened almost, right? So we would expect price to even potentially get above this right here. This is what we like to see. Now we're not in the big candles are slowing, right? As you're going up, the candles range or from low to high is getting smaller. This candle is smaller than that candle. This candle is smaller than this candle. And we have already crossed the 50 and the 100. So at this point, we are still bearish. Up, breach the 50, down. See that? Got all the way up, breach the 50, you're back down. At this point, on a gap down, when you're coming into this, notice how small this candle is, right? Up, big candle, smaller candle, smaller candle, smaller candle, and then you get a big gap down. That tells you right off the rip, because you can see where you're going to open pre-market. You would be looking at post-market data, and you would see that price came up and then went down through the middle of the night during the Asian and London sessions. That open is at the New York session. Look where the open is. It's right at the 21. You could simply have sold the open on that day and used this candle's high as your stop loss. Let's proceed. Ooh, did it stop us out? Not quite. But the moving averages are still, because I said use the high, right? The high. We stretch it out here. You can see this candle's high. Let's just look at the numbers up here, right? We're looking for the H. So focus on that number. This candle's high is 45.90 spot 03. This candle's high is 45.95 spot 31. You would not have gotten stopped out one more. Nope, there it goes. Still did not get stopped out. You had nothing to fear. Now, even if you would have gotten stopped out, you could have taken re-entry on this day, because this day opened and moved higher, right, into what we call resistance. That close, since it's the highest bullish close in this price action, that is resistance. That is, especially with a moving average structure like this, that is a short entry. A flawless, beautiful short entry, right? Perfect short entry. And you capitalized on that day as well, nicely. Hopefully you took profits and held on, because boom, right? And then watch. So back down to the 200, which is what, some people expect to be support. You will have buyers when they figure that the trend has not changed yet, that this is just a deep pullback, a deep correction to the 200. This is a retest. It's a higher low as compared to this low as well. So people are going to buy into that, but we are still short, and we're short from 45.89, closed back under. Now watch the magic. Oof. Got down, made a fresh lower low, and you are entered on this day, because this 21 moving average is below the 50 and below the 100. It's getting even better for us as far as for short entries, because what has happened now? Now your 50 has crossed below the 100. So this means literally that you're getting pretty close to crossing this 200 down here. And once that happens, your moving averages are going to slope a lot steeper to the downside. And you never got back above. And here comes your cross. It started to cross there, but we gapped up, closed up, gapped up, closed down. Now you're crossing. There's your cross. So now your 21 and your 55 are below the 100. And now your 21 is below your 200. So you can see just by using the moving averages and interpret what they are saying, that if price doesn't rebound soon, there is a huge chance that we are going to see a much further move to the downside. Let's play it out. All right, there is that move to the upside, right? This is what bulls wanted to see. And Now your moving average is sloping to the upward direction. However, are you above the 50? No, you are not. Are you above the 100? No, you are not. Are you even above the 200? No, you are not. Even though you have this move to the upside here, which in most cases, people would assume that this is going to be a bullish breakout. Remember, traps exist. Price can trade all the way up into here, right? There it is. But what happens? You have a gap down, close down. And your moving average structure is still structured bearish. Gap up, close up, gap up, close up. What's it going for? It looks like it's going for that initial first short entry. Stops happen. There it is. Stopped out. Next day, down. Take the next short. Right there. This is resistance. Just because you got a bullish close above and a bearish close above does not mean that you're going to see a move to the upside. All right? Because traps exist, and this is what we call a trap. I have a video on traps. It's on my smaller channel, but this is a trap, so we are not concerned. We are still bearish. All right, so now what's happened here is you have gotten to the point to where on the daily time frame, right, you are looking like, hey, this is getting bullish. It's getting bullish. Next 2 days, nah. All right, so now you're going to see the real big move to the downside. This was just a stop run from the flawless short that was taken here. Okay? So the moving averages in this situation are still bearish. They're still bearish. Even though you got back above the 50 and the 100 on the 21, the 50 did not get back above the 100. If the 50 would have gotten back above the 100, you would have been structured back to bullish. That did not happen. What I'm saying here, let's get rid of the 21 and let's get rid of the 200 so I can show you what I'm talking about. Notice, once you made your cross here, even though you had this wild spike to the upside to run stops, whereas the 21 is sitting here and the 200 is like right here, remember? You're still structured bearish because the 50 never made its cross back to the upside on the 100. All right? Now, like I said, we know that this was the beginning of the bear market. Look how price just jacks around here, right? But we don't use moving averages for entries. We use price levels, but I don't want to get too much into that. Right there would have been a short entry for us based on the fact that the moving average structure was bearish. There is your death cross. And in this scenario, the death cross happened while price was still real close to the 21. A lot of times you'll see on big down moves, you'll get this moving average structure where the green 55 closes below the purple 200. That's called a death cross. Oh boy, the algo switched to kill mode. And then we can just hit play and let it play itself out here. See, now the 200, this pause. Now the 200 has been crossed by the 100. You are in a bearish trend. You are no longer in a bullish trend. Look at moving averages and how to anticipate what price is more than likely going to do given the moving average structure. All right. So anyways, bear market mode, looking for, highs to sell into. And at this point, I think I do remember we get above this. Yes, we do. Right in there. Yes. Yeah. Nice. And then right back down. So you can see how another bear trap was made there. Right. So moving averages can be very, very helpful. All right. So let's stop this nonsense and let's go look at something over here. This day is Thursday. This is last Thursday. I did a live stream and I told people that this moving average structure is bearish. It is bearish. 21 is under your 200, your 50 is under your 100. This is a bearish structure. I said that if we lose this 200, that price is probably going to have a fallout that we could revisit, probably back down to this support down in here. And that happened on that very day. Moving forward on Bitcoin on the daily, that's a bearish structure. Here on the weekly, it is a bearish structure. So basically what we were doing is we were watching the 21 exponential. And if we closed a weekly under it, which we never did, then we were going to switch our bias to bearish. That made us bearish. Then we got this really big, huge spike. So we got a bullish bounce. Also, the S&P 500 and the NASDAQ were both ripping. It was just a very bullish day all around. But I told people to look at the difference between the structures of these two assets on Thursday, right here, right? I was like, this is bullish. This is bearish. This isn't bullish. This is bearish. So we need to hold the 200. If we lose that, what do you think is going to happen? Price is going to go down. And look at the way the moving average on the weekly, the 21 is structured. It's down. Your 50 is arching down, all right? So this weekly close is going to be huge. If it closes under the 50, then the sell side people are going to be very, very happy. Now, with that being said, people were buying in here based on the 200. And if I pull in the 200 weekly here, the simple moving average, you can see it's still up, straight up. This is the last area to be a buyer. If we lose this, then people are no longer going to be buyers. They are going to start selling their Bitcoin because they don't want to lose the money they made from this rally. So as of right now, they have already lost $5,000-$6,000 per Bitcoin they own. Right? If you own multiple Bitcoin, that's a huge hurt. That's painful. If we lose this 200 weekly, they will just start selling. People sell on red candles. They should sell on green ones, but they do sell on red ones. I'm holding my Bitcoin bags as well. I don't know why, right? I guess it's just this thing of hope. I guess that's all you could say it is. It's hopium. Absolutely pure and sheer total hopium. Because at this point, the moving average structure on this asset is bearish. In fact, I did take a short entry because of it. All right, now that I've shown you how to identify once the moving average start to get doing that, what can you do for secular trends? Like you're in a bull trend right now on the S&P 500. It's suspect to me. Yeah, there's a lot of negative stuff going on out there. You have so many people calling for a recession. There's people calling for all-out death, destruction. But we've been bullish on this asset ever since this happened here, right? And then once the 100 crossed above the 200, that affirmed our bullish bias. All right, so what we're going to do now is we're going to go back to the S&P, and we are going to stay on the weekly because we've done our day trade part. Now I am going to show you longer term swing traders who are looking for secular trend growth. I'm going to go all the way back into the last bear market here. All right, 2008, very famous, right? Very famous bear market. It was a huge bear market. You know, when you own a retirement fund and you see it literally get like reduced by 50%, it really isn't fun. Right? This thing got reduced by 57%. That means half of your money is gone. Half of your entire savings, your retirement is gone. But the good news is in the market's entire history, it usually only lasts for a few years. As you get back above your 21, as you get back above and start closing weeklies back above the 20, that is not necessarily telling you that the bear market is over. Remember, this is just telling you that, hey, the trend may be changing. So why not start looking for bullish entries? You could have used this resistance. Remember, resistance is the highest bullish close. There's the breakout, right? You even made it higher, but then you pulled back to resistance. That would have been a buying opportunity. Very next week, you would have been up. Now you hold this, right? You hold it and see what happens. If you get stopped out, then the downtrend could be resuming. However, you're structured or bought into at a resistance area, a previous resistance, at around, let's just call it 875. And then you just hold. When do you exit? Well, in this point, you can exit when the 50 crosses the 100. Or if you want to exit quicker, you can exit when the yellow line crosses the 100. Where do we lose the 100 with the 50? So for this exercise, let's go ahead and turn off the 21 and 200. This is what we want to see. So when do we exit? When do we exit? When do we exit? When do we exit? We don't. You would still literally be in the trend from 2008 on the weekly time frame. So your $875 buy is looking pretty fantastic right now, sitting at 45.15. And it almost happens like that every time. Now, there was the 2001 bear market where your 50 and 100 crossed right here, and then you had a massive bear market right in here's where the 50 got back above the 100. So like if you just use these two moving averages, you're not going to catch the low, and you're definitely not going to sell the high. Even though, 8 years later was the financial crash, we had that again. So this is a situation where the moving averages would not have been much help, right? And it was during the 70s into the early 80s because we had a lot of stuff going on. Huge inflation, oil embargo, all kinds of stuff. But prices remained steady from $86 to $108. That's only a $20 fluctuation in price, and that took many, 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 many years. So you're fine, right? You're fine. And then if you want to wait for all the moving averages to be structured before you buy, you would have been buying up here, right? But for long-term secular growth, that buy at $100, $104 pays off in the long term. Massively pays off. Moving averages can be used to help you interpret what price may be doing, but you just got to play with them a little bit, get them, get to know them. You know what I mean? You don't have to use them on every time frame, just the daily and the weekly. So if you're going to see any type of trend change, if you want to be a near-term trader, then you just stick with me, right? If you want to be a long-term holder, well, you just buy and hold. That's what you do, typically. And in bear markets, buy more. Bear markets, buy more. A lot of people are saying that we're in a bubble and we're going to see the worst crash that we've ever seen, probably like back in the 20s or whenever the Great Depression was, but I do not believe that. I do not believe that. A lot of people will say price does not dictate how good the economy is. Yes, it does. I disagree. All right? Everybody that is still bearish from the 2022 bear market, they have missed out on phenomenal gains for 2023. They let their bearish bias completely let this market run away with them. Now, I'm not saying that we're not going to see a recession. Right now, price is not saying that we're going to see a recession. All right. Right now, price is just a hop, skip, and jump away from its all-time highs. $300, almost $300 exactly. And for the S&P 500, you can reach that in 4 or 5 weeks easily if you have bullish momentum like we've seen through here. This was a big pullback, but we didn't lose any major moving averages crossing-wise, right? We lost them on price. And we were looking for shorts here, and I was looking for shorts and got killed all the way up to here, right? Because I'm more of a near-term trader. But moving averages, the structure, how they are at any given point in time is good to help you decide what you want to do or not. Thank you guys so much for being here. Hopefully I was able to teach you something, and make sure you guys have a fantastic rest of your weekend. Make sure you guys trade safe. Make sure you trade smart. And as always, happy trading, everybody.